Welcome to the webinar. I'm Heidi Tennant, NAPFA Senior Coordinator of Membership and Continuing Ed. Our presenter today, Ben Birken, is a CFP who has 15 years of financial advisory experience. In addition to his role with Holistiplan, where he helps advisors understand software and the world of tax planning, Ben continues to work as an advisor at his firm, Pisces Financial Advisors. This dual role makes him uniquely qualified to understand the challenges advisors face when practicing tax planning and communicating important concepts to clients. I should also mention that Ben's colleague, Griffin Kale, will be answering some of your individual questions under the Questions tab. Thank you, Ben, for joining us today.
Thank you, Heidi. It's a pleasure to be here, and thank you to everybody at NAPFA and everybody who's participating in the webinar. Always glad to see folks interested in tax planning, and also just good to actually be presenting to fellow NAPFA colleagues. This is kind of a treat for me. So thank you all for coming, and let's get into it. So at Holistiplan and as an advisor, I'm a big believer in the idea that taxes don't just happen once a year. That's why we wanted to come and present to you all about this concept of thinking about tax planning, not just in discrete chunks, but as a year-round sport, right? So what are we trying to accomplish today? Well, we want to identify the elements of a year-round tax planning service. So what all might go into that? Have a little bit of a conversation about some of the misunderstood elements of tax calculations, primarily so that we can think about better ways of communicating those concepts to our clients. And then finally, communicating the tremendous value of tax planning to your clients. I think that's going to be embedded throughout all of this. Once we start picking through all the different elements that go into a full tax planning service throughout the course of the year, you'll be able to communicate back to your clients why that's such a value that you bring. So we're all aware that taxes are due most years on April 15th with the extensions into October, but we know by the very nature of this presentation that we need to think beyond just April 15th, right? Every quarter of the year has some time-sensitive tasks that are going to be important to complete as they relate to tax planning. Trying to do all of those things before a meeting is probably impractical. And so a robust tax planning service is going to have scheduled tasks happening throughout the year. Now, that's all well and good, but when we're working with clients beyond just a handful, business constraints require us to do tax planning at scale. We could all, if we just had one or two clients, we could do a bang up job for them and do all sorts of things ad hoc. But once you start expanding your client roster to 10, 15, 20, 100, 400 people, the ability to do things on that ad hoc basis and not at scale becomes cost and time prohibitive. So we need to think about how can we build that robust tax planning service at scale. But as we're doing that, I think it's an important aside to think about how your clients see their tax return. So what does a tax return look like through the eyes of your clients? Well, the first thing is that it's long and poorly designed, right? Kind of like this staircase that leads into the ceiling. The tax return is not a very digestible document. Just as one simple example, we're familiar with the concept of marginal effective tax rates, but those numbers don't show up anywhere on a 1040, right? What else? Well, your client's tax bill, for the most part, probably represents their biggest expense over the course of the year. It also presents a potential legal problem if they get something wrong. And, I'm kind of partial to the quoting from the song, "More money, more problems." Well, the more intense your tax return is, the greater likelihood that you're subjecting your client or your client subjecting themselves to potential legal action when they get it wrong. And then for a lot of folks, including a lot of advisors, right, looking at a tax return makes them feel helpless and uninformed, right? There's a lot of things that are going on there. It's very poorly described. So we can do a lot for our clients by helping them understand this document a little bit better. Now, as you think about what you do beyond just tax planning for folks, all the various strategies that we implement that we know are good, solid strategies, think about, are we adding or reducing stress through the course of doing that? So we might think that we're doing a great job of optimizing taxes for people by doing things like qualified charitable distributions or Roth conversions or any of the other things that we know are good, solid long-term tax strategies. But in doing that, we've got an increased error potential, which might end up creating some stress on behalf of our clients, even though we've all done all this with the best of intentions. So one idea to get ahead of this reducing of stress is let's add some tax communication to our ongoing workflows and be proactive about some of the things that we're doing. So what we did at Holistiplan 2 years ago is we went out to our users and said, what are the different things that you all are doing in these different quarters? So in Q1, Q2, Q3, Q4, what tasks do you do every year in these quarters? And we got some great responses back. So we got 75 activities for Q1, 63 in Q2, 43 in Q3, and 95 in Q4. And we're going to walk through this sequentially, just like the calendar. So when we start and think about Q1, and we're going to break this up into task categories, specific things, how do we deal with this in terms of scalability and so on. So you're going to see some consistency as we go through each of the quarters. So your Q1 task category, so your January, February, March, these are the actions that are going to be best done at the beginning of the year, as well as helping folks get ready to prepare their tax return. Right. So what are some of the actions that are best done at the beginning of the year? Well, for those of you who are working with trusts where income needs to be paid out, or you have the discretion to pay it out, that's got to happen by February, right? So you've got a certain number of days at the end of the calendar year before you can go back, before you have to go back and say any of the income that should have been distributed by the end of last year has been distributed, or that a trustee who has discretionary authority has made the decision to distribute or retain income. We know that IRA and Roth IRA contributions, as well as SEP and solo 401k contributions, need to be done by the tax filing deadline. The SEP and the solos, you have until the extension deadline, but the IRA and the Roth IRA have to be done by that April 15th deadline. If you did any tax loss harvesting at the end of Q4, you might want to come back and revisit some of those positions and see, do we need to come back into those that we exited after the wash sale is done? I suppose similarly true if you did anything from gains that you took in Q4. Is there any sort of follow-up that you need to do in Q1? And then this is a little bit harder now, but when there was recharacterization still on the table, if you knew what your income levels were going to be, you could do a Roth conversion. Previously, you'd be able to recharacterize anything that you didn't like to that you didn't want to convert. Now, you might do a partial conversion earlier in the year with a fuller conversion later in the year once those income levels are solidified. How do we do some of these things at scale though? Well, one of the things you're going to see is how are we best able to segment our clients for these different things. So one segmentation idea might be accumulators who have made or will make IRA contributions, as well as do you know which of your clients are either trust beneficiaries or trustees, or can you easily segregate that within your CRM or some other system? Do you have template reminder emails that can be sent at the push of a button, right? Crafting the same email over and over again is not a great way to do things at scale, but if you've got the same template of an email to go out, that's going to help things go a little bit smoother. What about helping folks prepare to file their tax returns? Well, we know that there are some issues that come up at the federal level, and then even more that happen at the state level, depending on certain rules within your state. So, what are the things that we can do to help? We can make sure that our clients know what are the 1099s and/or K1s that they should be looking for. Sometimes advisors will even download them and provide them to their clients. Qualified charitable distributions. So, a custodian is going to do a great job at telling your client, this is how much money left the account, but none of them are distinguishing between what was a charitable distribution and what was not. And if your client's not aware or just doesn't remember and simply hands over a 1099-R to their tax preparer, guess what? That whole thing's likely going to end up as a taxable distribution that you're going to have to go back and correct later on. If there are any 60-day rollovers that happened as you crossed over from one year to the next, that's going to be something that's going to be important to know as a client's preparing their tax return. And then just general warnings on common errors. So Form 8606, the different tax rates on collectibles, anything having to do with accrued interest on bond purchases or sales, right? These are things that aren't always captured well on custodial documents that are used to generate a tax return. Just as an aside, some of the benefits that we think, both again as an advisor, but also at Holistiplan, some of the benefits of a tax prep letter, it allows you to be more proactive than reactive. So instead of reacting to client conversations or questions, you're getting ahead of things. You probably know the accounts better than the CPA, and you have been with that client throughout the whole course of the year. You know the little intricacies that have gone on and can explain things in a better way. It's a CYA issue. If the CPA makes an error and points a finger at you, you've already done your job in telling them this is what was supposed to happen. It avoids time explaining mistakes for self-filers. So even though we might encourage many of our clients to work with a CPA or a tax preparer, we know we still have folks who are going to do it themselves. The better we can do a job of preparing folks before they file the return, the fewer questions we're going to have to answer as they file that return or after they filed the return. And then right or wrong, if your strategy led to a particular error, your client's going to walk away with a bad taste in their mouth. So, putting together a tax prep letter is a good practice. It's challenging though if you don't have a template or an easy way of doing it. So, one of the things that we have at Holistic Plan, and this is just an example, this is not what you have to do, but just conceptually as we think about this, you can put together this letter that you can give to your clients as they're getting ready to prepare their taxes. Here are the documents that you should be expecting from your custodian. Here are the activities that we did that are going to have implications for your taxes, be they a Roth conversion or a contribution to a donor advised fund or directly to a charity or a qualified charitable distribution. Laying things out. Here's what you did, here's how much it was, and here's how you should be thinking about it as you prepare your taxes. How do we do this at scale? Again, as we're thinking about prep, do we have a templated document? Is there a spreadsheet summary for a CPA where if you have 4 or 5 or 10 clients in common, you can deliver them one single thing as opposed to on an ad hoc basis? That's going to go a long way about making you look in the eyes of the CPA. Are you taxable events throughout the course of the year? It is not scalable, especially when you have hundreds of clients to go back and research every single tax-related thing that you did in January. So are you working that stuff into your workflow about keeping a running file as you do a tax-related event for a client? And then, one other thing that's helpful, can you download the 1099s into a single zip file, right? That's with multiple accounts, you're gonna have multiple 1099s and multiple files. That's not the most convenient way of doing things. For you as the advisor, it might be helpful to have all of those 1099s in a single file as opposed to having to go in and find each individual client's 1099. What about Q2? So now we're into, let's see if I can do the math in my head, April, May, and June. So big things that are going to come up in April, May, and June, folks will have filed their tax returns. And now it's up to you, we think is a good practice, to return that tax return, to review that tax return. You're looking for errors, you're looking to make sure you understand all the numbers on the page, as well as some cash flow planning. And we'll talk about what that means in just a second. So as you think about a tax return review, what are the things that you're going to get out of that? And what are the things that your client's going to get out of that? So one of the first ones is that it allows you to double check your spending assumptions. At a very broad level, spending is going to be equal to income minus taxes minus contributions. And I suppose there should be another minus here, directed savings. So not to say a 401k, but to a brokerage account or some other non-qualified account. By definition, whatever's left over after taxes, contributions, and savings has been factored out, that's going to be your client's spending. So a great way to back into a client who says, I only spend $50,000 a year, but you do this calculation and you realize, there should be $100,000 left over if you only spend $50,000 a year. What else? Did they make any errors, right? Sometimes the errors aren't malicious. Sometimes it's, or just even wrong. It's just tax preparers are going to work with the information that they have. So one of the biggest ones that is going to happen again is a QCD that gets coded incorrectly, or sometimes, a client will say, yes, I made a charitable contribution of $50,000, and you see it show up on their Schedule A, when in reality, that was a $50,000 QCD, right? So now you got to go in and correct that somehow. Find planning opportunities and pitfalls. So are your clients taking advantage of all the tax planning opportunities that they have in terms of contributions to certain accounts, eligibility for certain credits, deductibility of certain things? Identifying portfolio opportunities. So you can look at Schedule B, and if any of you have clients that are like mine, sometimes they don't always tell you that they've opened a new checking account or a new savings account or a new something account. Well, if that account's generated any interest, that's going to show up on Schedule B, and all of a sudden you now have an opportunity to say, oh, we should probably add that to your net worth statement. Similarly for Schedule C and E, right? So I happen to work in a town where there's a lot of university professors. They will get honorariums for certain things and not say anything about it because it's just the normal course of their day. Well, that's going to show up on Schedule C, and that's an opportunity potentially for self-employment retirement plan contribution. And portfolio tax efficiency, as it relates to asset allocation. Are there a lot of short-term capital gains that got generated if you're looking at a prospect's tax return? Or is the ratio of tax exempt to taxable income appropriate for that client's tax bracket? And also, demystifying the document. So unfortunately, as we've already talked about a little bit, taxes are complicated, particularly if you're not used to the way any of this works. So just some common misperceptions that we see all the time, the belief that all of your income, all of the taxpayers' income is taxed at their marginal bracket. We know that's not true, but that's a common misperception. Capital gains are always taxed at 15%. You see that all the time in news articles, but in reality, there's 3 different capital gains tax rates right now, right? 0, 15, and 20%. Social Security is always 85% taxable. Well, that's also not true, right? It could be 0% taxable or 50% taxable or some mishmash of all of that. And that tax-free income from municipal bonds is always a good thing, right? People love the idea of tax-free, but that's not always true either, because if you're in a lower tax bracket, the lower stated income of a municipal bond might not really be the best after-tax result for somebody. But how do you do all this? How do you show all this to people? There's got to be a way of doing it. So here's an example right here that's something, one possible way of doing a tax return review for people. So you show the key figures, the most important things that they might need to know, the concept that ordinary income is broken out into, that taxable income is broken out into 2 different features, 2 different buckets, right? Ordinary income, which is where the marginal tax bracket is going to apply, and capital gains and qualified dividends, where that preferential tax rate is going to apply. This particular example is interesting, where if you were to just look at their taxable income, where it says $27,676, most tax returns, the summary information is going to say, well, that person's in the 12% tax bracket. Well, that's not true, right? None of their income is getting taxed at 12%. Their ordinary income is actually 0 because their deductions eat away at all of their ordinary income. So technically their tax bracket's 10%, but really they're not paying anything on it. And because their taxable income is below $80,000 as a married filing joint person, as a married filing joint household, all of their capital gains and qualified dividends get that super preferential 0% tax treatment, which is why their marginal rate might be 10% on ordinary income, but their effective rate is actually 0 because they didn't pay any taxes. That's going to be an important concept for people, and showing them the impact of moving money out of the 0% bracket and into that 15% bracket for capital gains becomes super important for your lower income folks as you're thinking about Roth conversions, where you might think you're doing a conversion in the 10 or the 12% bracket, but because you're pushing capital gains from 0 to 15%, the effective rate of that conversion is actually 27%, right? So a bunch of other things that you can talk about here as you're thinking about tax return reviews and just helping clients understand what's going on with their taxes. Again, though, how do we do this at scale? Templates are going to be a big theme here. So a template to just request your client's tax returns, either directly to clients or to their CPAs, as well as that deliverable that describes findings, a version of which we just looked at. Consistency. So do you have a checklist that you're going through as you're looking at a tax return? Do you have the calculation worksheets handy? Automation, are you doing this yourself manually, or are you using a computer to help you do it? And is there a way to mail merge those results from a checklist into a deliverable? So just as an example, not even on the tax related things, but here's an example of a documented process. This is the Toyota multi-point inspection. What do we see? Well, it's consistent. It's an intuitively designed checklist for the technician, and it identifies opportunities for further engagement. So in this case, anything that showed up as a red check mark is something that's going to require further attention or requires immediate attention, right? Now, as an aside, if you don't have a tax return checklist that you're using, just go ahead and email us at info@holistiplan.com, and we'll be happy to send you a copy of one. One of the other items in Q2, though, was this concept of cash flow planning. So once you know what your client's tax bill is going to be, depending on the nature of that bill and the nature of their income, have we built estimated taxes and withholding into the cash flow plan for the year? So if you have a client who's going to be making quarterly estimated payments, are they going to have the cash on hand to do it? And can you set up regular distributions to them if they don't happen to have that cash on hand from a particular investment account? Similarly, once you've gone through that exercise of looking at spending equals income minus taxes minus contributions minus savings, is that an opportunity to update the spending assumptions for long-term projections. Scalability, again, do we have an updatable cash flow plan for each client? Do we have a consistent deliverable for that client? You know, that could be anything from a spreadsheet to something that gets produced in Money Guide Pro or eMoney or some other long-term planning assumption program. All right, what about the third quarter? So as we start getting into this third quarter, which is, again, see if I can do this correctly, July, August, September, this is when we have a little bit of a lull, right? So when we did this survey out to folks in the holistic plan community, this was definitely the quarter where we had the fewest people doing things, but there were still plenty of things to do. So one of the things, as you're thinking about this third quarter, are you starting to get ready for the end of year prep? Now, maybe that's not something you think about in the early summertime, but as you get into September, usually you're seeing that income picture firm up, particularly for people who aren't, say, working on a bonus structure or whose bonuses happen earlier in the year. And also, are you thinking about withholding or estimated taxes, right? You're getting towards the end of the year. Have you done more or less or just right on target for what you think your client's projected tax liability is going to be? So what does that look like in some more concrete terms? So just hypothetically, if you've got higher income clients, it's possible that their paycheck has hit that Social Security cap by this quarter, right? Where at some point they're not going to have any additional FICA withholding for Social Security and their paycheck looks a little bit bigger. Now, that might be a great opportunity to talk to them about, hey, that amount that you were paying towards Social Security, maybe we redirect that into some other form of a savings or investment account for longer term growth. Opportunity to look at maybe changing your withholding levels to avoid a large refund. So if you're having excess amounts of dollars withheld that's going to result in a refund, we all know that that's an interest-free loan to the government. Maybe there's an opportunity to change those withholding levels and change your client's cash flow picture for the remainder of the year. Or if it looks like they're not having enough withheld, can we increase those withholdings so that we avoid an underpayment penalty and interest? Similarly, for folks who might not have paychecks anymore, are we looking at opportunities to change the withholding or change estimated taxes as it relates to Social Security, IRA distributions and RMDs, or pension withholding? So, you know, there are a number of clients who they might not like to make those quarterly estimated payments and would just prefer to do everything in one simple withholding from an IRA distribution. How do we do this at scale? Again, kind of coming back to something similar from that Q1 side of things. Can we group our clients by particular categories? Retired, accumulators, high income accumulators, right? Your retirees might be the ones where you're looking at RMDs and thinking about withholdings there. Your high income accumulators, those are going to be the ones where you might want to target in terms of their Social Security being capped out and the opportunity to redirect some of those dollars towards investment accounts. Requesting pay slips at predetermined dates. So if you know on, say, the end of the quarter, midway through the second quarter, you've got a good handle on what 75% of the income picture is going to look like, here's your opportunity to request that pay stub in July or September and say, yeah, this has got us 75% of the way there. If things continue this way for the next 3 months of the year, we now have a really good vision of what withholding is going to look like, and we can make some of those adjustments. Now, in this case, the deliverable is probably going to be a little bit more ad hoc, right? Because things are going to be a little bit different from client to client. So just an opportunity and just something to notice here that there might not be that consistent deliverable like there are in Qs 1, 2, and as we'll see in 4. As we're thinking about transitioning into Q4 though, we might be, if you're using tax projection software, regardless of what it is, if you haven't been doing things along the way, now we're starting to tee up our projection software for what are going to be some of those important Q4 tasks that we'll talk about in just a little bit. So examples of that might be end of year gain loss harvesting, right? Are we looking at our portfolios? And if you haven't been doing tax loss harvesting throughout the course of the year, are you starting to identify those positions or those lots, depending on your investment style or your investment management style, about taking those losses and harvesting them? Or the less talked about but potentially highly effective is if you're anticipating a low income year where your client's going to be in that 10 or 12% tax bracket, is there an opportunity to start harvesting some gains and pay a 0% tax rate for that client? If charitable giving isn't something that's been going on throughout the course of the year, are we starting to have those conversations with clients in that third quarter, or ideally throughout the whole course of the year, but at least here in the end of the third quarter, to talk about what their charitable intent is over the course of the last part of the year? This is actually way more important, at least anecdotally, now than it might have been a few years ago, particularly depending on the custodian that you use. The longer your clients and you wait to make some charitable giving conversations or decisions, you start running into this risk of, oh boy, my custodian didn't process that correctly, right? So particularly if you were anticipating doing a qualified charitable distribution for a year to satisfy a required minimum distribution, that has to be done by December 31st, right? The IRS may go lenient on you if you say, look, my custodian just didn't process it, I submitted it in time, but chances are they're not. So the earlier you have those conversations and can show your clients the impact of some of these decisions, the better off you and your clients are going to be. Same thing for end of year Roth conversions. Again, we know that has to be in by December 31st. The conversion has to happen by December 31st, but every custodian, regardless of who they are, is going to tell you this is the date that if you get a conversion form into us, we'll guarantee that it's done by the end of the year. But if it's after this, it's going to be a best really guarantee that it's going to happen. With similarly required minimum planning, if that you wait until the very end of the year to do RMDs to maybe maximize the amount of time that something is in a tax return, in a tax preferred account, you'll definitely want to start having that conversation about required minimum distributions. How do we do this at scale? So if this is going to be that time, that lull when there aren't as many things going on, this is your chance to start pre-populating your tax projection software, right? Either you, or if you're in a multi-advisor firm or you have associates that might be able to help, how do we start using that time to put stuff into our software? And then, a second component of this, how do we build decision trees for when to pursue a given strategy? Not saying yay or nay to any of these, but some firms, some advisors have very robust or very adamant about their strategies for when Roth conversions take place. Some folks say, if I can't project what a client's tax bracket is going to be in some period of time, then maybe the Roth conversion isn't such a great idea. Or if I'm not convinced that the government's going to maintain its promise that you're never going to have to take a distribution from a Roth and it will always be tax-free, maybe I'm less inclined to push hard on such a Roth conversion, where others might say, I want to get money into an after-tax or a tax-free account as early as possible. Either one can be valid. It's not really here. We're not really here to pass judgment on any of those things, but it's more about, do you have a process in place, particularly when you have a lot of clients, where you're reducing the amount of time and mental effort and energy that goes into making a decision for a client? Have you built out a decision tree for when to pursue a given strategy? I've said Roth conversions as one, but another one that comes up all the time is donations, right? Donating appreciated stock versus doing a qualified charitable distribution. Good arguments to be made on both sides as to which one is going to be better or worse for a client. But there are going to be factors that might influence that, like the existence of appreciated stock to give, or the amount of what a required minimum distribution might be, or something that's maybe not as well talked about, but are you going to do a qualified charitable distribution for a client of any dollar amount, or is there going to be some minimum dollar amount that you won't do it because of the administrative hassle involved? Building these decision trees out for when to pursue a given strategy and how you're going to do it at your firm is going to help you do these things at scale. Bonus task for Q3 would be anybody who filed for an extension, right? So we're coming up on that October 15th deadline. We know we still have SEP IRA and solo 401k contributions that can be made. up until that October 15th deadline. So trying to get a handle on some of these things now in this Q3 is a good idea. Being ready for any of the reviews that are going to come up in October for anybody who's submitted a tax return on extension and is waiting until that last possible minute. Do you have the ability to easily and quickly pull a list of clients who have filed an extension? Do you have CRM capabilities in place to do that? One of the other things I should have mentioned when I was talking about some of the stuff on Q1 and Q2, do you know who all of your clients' tax preparers are? Are you using your CRM in such a way that you can easily pull a list of tax preparer A works with clients A, B, and C, right? If you don't have that, this is a really good, Q3 is a good opportunity to make sure everything is up to date. And that can even be sometimes as simple as, are you planning on using this tax preparer going forward, right? Because sometimes clients will change their tax preparers and they might not tell you. So, you can use this bonus time of Q3 when things might not be as noisy to do some of those filler tasks. Q4 is going to be the next big, well, it's going to be our last quarter, right? By definition, it's going to be our last quarter, but it's going to have some of the more important and certainly time-sensitive tasks because you have that December 31st deadline coming right up, right? And we know, because we've already talked about the fact that there are certain things you just have to have them done, and if they don't, you're in trouble. But you can also start using Q4 for planning for the next tax year. The next tax year. So as we finished up 2021, were people thinking about what 2022 might look like? That's going to be particularly important as we're thinking about the role of tax planning as not being how do we pay the lowest tax ever in a single year, but how do we keep our clients' lifetime tax obligations as low as we possibly can? Sometimes that might mean paying tax in 1 year means a lot less tax 3, 4, 5 years down the road. So how are we thinking about this multi-year tax planning strategy? So what are just some of the things that have to be done by the end of the year? And we're going to break this out into 2 slides. So one thing that needs to be done, we talked about this, gain loss harvesting, right? Do we have a good handle on what our clients' projected tax bracket's going to be or taxable income is going to be so that we know to focus on gains, where we might get them at 0% or losses, right? There are some folks who might say that generating a tax loss for somebody in the 10 or the 12% tax bracket isn't really doing them very much. Whereas doing something in, say, the 30 or the high 20s or the low to mid 30% tax bracket, that tax loss is going to work a lot more in their favor. By the end of November, we should have a really good idea of what sort of mutual fund distributions we might expect, right? So there have been a handful of mutual funds in most recent years where the distributions have been a significant percentage of the NAV. Having a good handle on what that might be can give you some clues about, just on the portfolio side, are there lots that you can sell to offset those distributions that you can't do anything about? Or sometimes the distribution is going to be more than what your client's embedded gain is in that position. So if the distribution is going to happen and you can't do anything about it, is there an opportunity to make a sale where the actual tax implication is going to be less with a sale and a realized gain as opposed to a distribution coming from that mutual fund, particularly if that distribution is going to be of short-term gains? Withholding on end of year distributions. So as we talked about before, when you were at the end of Q3, are we teeing things up so that people aren't over or under withholding, so that we can either avoid sizable refunds or sizable underpayment penalties? Charitable stuff. So with the passage of TCJA and the higher standard deduction, charitable giving as a tax strategy got a little bit more challenging, right? A higher standard deduction meant that it would be harder to get charitable deductions particularly for clients who don't have any mortgages anymore, right? Getting over that standard deduction threshold got a lot more challenging. Doesn't mean it's impossible, but it meant that we have to start being more aware of the true total charitable giving amount that somebody would have to make before they're eligible for a deduction. So the first bullet point, though, it doesn't have anything to do with that. It has more to do with the fact that we need to be aware of the AGI constraints as they relate to charitable deductions. Not every charitable contribution is created equally as it comes to being able to be deducted. So cash might have a different deductibility than donating appreciated securities. The nature of the recipient charity is going to be important in terms of determining deductibility. Is it a 50% limit organization or a non 50% limit organization? Is it appropriate to donate appreciated assets versus donating cash? Most of the time, the answer is yes. But there might be certain circumstances, particularly as the AGI limits changed last year or the year before, where depending on your client's circumstances, cash might have resulted in a greater deduction, at least in the present year. It might not be the best long-term strategy, but in one particular year, it's possible that a cash donation resulted in a much more sizable and usable deduction than donating appreciated securities. And I'll talk about that a little bit more in a minute. Talking about qualified charitable distributions, again, these things, qualified charitable distributions for folks who are 70 and a half or older, great opportunity to do something that isn't going to impact AGI. And for folks who are at 72 and older, the QCD can work to offset some of the required minimum distribution by doing a QCD as opposed to taking a distribution from an IRA and then doing a charitable contribution. You're both potentially increasing the true effectiveness of tax efficiency of a distribution, because a QCD by its definition is 100% tax efficient. It's effectively deductible. But also by not taking the distribution, you're helping keep your client's adjusted gross income lower, which might make them more eligible to take a greater medical deduction, because that's going to be something that's going to be dependent on adjusted gross income. Donor advised fund setup and funding, huge explosion in popularity of donor advised funds. For folks who aren't familiar with them, a donor advised fund is in itself a 501c3 charity. So you can donate cash, you can donate appreciated shares of stocks, mutual funds. You can, depending on the donor advised fund, sometimes donate some pretty complex assets, privately held stock, things of that nature. But they're going to take a little bit of time to set up and fund. Setting them up is pretty easy. Funding them can be more challenging depending on where the assets are coming or being transferred from. But the nature of the DAF is a really nice one, where the contribution to that donor advised fund qualifies as a charitable gift, but the person who owns the DAF is not required in that same year to distribute anything into that donor advised fund to a recipient charity. So depending on the nature of a client's circumstances, a very high income year, you might make a significant contribution to a donor advised fund for a client who might be philanthropically inclined, but isn't mentally prepared to send a whole bunch of money to a single charity or a couple of charities and wants to space that out over time. Donor advised funds are great vehicles for that sort of thing. So I talked about the importance of being mindful of the limits for charitable deductions as they relate to AGI. This is a screenshot from Holistiplan, but it's just to indicate the different categories where, when you're calculating a charitable deduction, you have to be mindful of all of these things. So a donation of appreciated stock to a 50% limit organization, which is going to be most 501c3s, you're limited to 30% of AGI. So somebody who has an adjusted gross income of $100,000, if they make a $100,000 donation of appreciated stock, they don't get a $100,000 deduction. They get a $30,000 deduction with $70,000 that can be carried forward, but only for 5 years. So depending on your client's circumstances, if they're not going to be able to use up that carry forward in a particular year or a particular 5-year stretch, maybe cash might be better because they might get a better, higher deduction. Not saying always, I'm not saying necessarily, but it's just the sort of thing that you want to be mentally prepared for ahead of time. What else must be completed by December 31st? Again, Roth conversions now. So if we've got a good handle on income knowledge relative to, say, where we were in Q1 when we first brought this up, we know that that has to be done by December 31st. We might want to think about accelerating business expenses. So if we've got expenses that would therefore be deductible this year that might be on the docket to be paid in that first week of January, is there anything that we can do to bring those expenses into the current year to increase deductibility? Can we shift income by delaying or promoting scheduled distributions? So if we know that this year and or next year is going to be a higher or lower tax year, is there anything that we can do in terms of timing for some of these things? Remind folks about flexible savings accounts. So FSAs, unlike the HSA, FSAs are the use it or lose it accounts. So if you have clients that have FSAs, are you being able to remind them, hey, you've got to empty this account out? I don't think this one actually has to be by the end of the year. You do have a little bit of a grace period, but this is the sort of communication that you want to be having with your clients so that money doesn't go burned up, sitting in an FSA that wasn't able to be used. Do you have folks that haven't done the max out for their 401k, 403b, 457, or I suppose in some states, in some cases, the 529 plans? This is particularly important for folks where, as they've turned from 49 to 50, they're eligible for that catch-up contribution amount. So if folks aren't necessarily paying attention to that, do we have some time in the last few months of the year to make sure we hit that upper range of any of these contribution limits plus catch-ups? 529s, in my head, this is more of a state-by-state thing and not so much a federal thing. I say that only because the federal maximum that you can put, I mean, there is no federal maximum that you can put into a 529 plan. I think that's determined on a state-by-state basis. But depending on the state where your clients live, they're going to be eligible for certain tax credits or tax deductions. And sometimes it's unlimited, but sometimes, there's going to be some maximum amount that if they're making a contribution and that tax deduction or tax credit is going to be important to them, have they done as much as they could do to maximize those credits or deductions? And the last one might be conservation easement. So again, this is similar on the charitable side, but is that conservation easement going to be done and completed by December 31st to count towards this current tax year? How do we do these things at scale? Well, some of these are one-offs, so they're kind of hard to scale. So the earlier that you can tee up the analysis, the better that you're going to be. Talk about Q3s, draw from language in your communication, trying to work decision trees, your workflow. Thinking about next year, right? So by the time we're in Q4, certainly by the end of Q4, we know what the contribution limits are going to be for next year. So at the end of 2021, we knew that in 2022, what contribution limits were going to be for 401ks, for other qualified plans, for IRAs, things like that. So that we can start planning ahead and getting clients, particularly those that are still working, if they need to make manual adjustments on their payroll deductions to make sure that they're going to hit those new maximum contribution amounts. For folks who in that next calendar year are going to have a whole bunch of age-related milestones, so the first year of taking a required minimum distribution, the first year they could do a QCD, the first year that they're either eligible for Social Security or have hit full retirement age, or when they hit age 70, are they prepared to start taking Social Security? We've actually had a couple of cases, internal to Holistic Plan, where folks have said, what do I do for a client who waited beyond age 70 to take Social Security because they just thought things kept growing? Well, you can't do anything about that. But so the earlier that you can communicate some of these things, the better off your clients are going to be. Just mentioned catch-up contributions. So are folks ready to up their 401k, 403b contributions to take advantage of some of those catch-up contributions? Medicare. So we know that Medicare starts at age 65, but Medicare-related surcharges, since Medicare premiums are based on 2 years prior tax return, are we thinking about income-related things in that year where we have to be aware of what those surcharge limits are going to be? And those are tough, right? Because those surcharges are cliffs, meaning if you go $1 over the Medicare surcharge threshold, just by $1, you've got a new surcharge for parts B and D over the course of that whole calendar year. And carry forwards, be they charitable carry forwards that we talked about or tax loss carry forwards, where you can use $3,000 of any realized loss to offset income, and anything that's left over gets carried forward into the next year where you can use it to net out against gains in that next year. Again, scale, templates for communication. Have we pre-built lists or tagging for faster querying? So how quickly can you pull a list of all clients who are maxing out their 401k contributions every year? How quickly can you pull a list of all your clients that are turning 50 next year? The easier that you can do this, the better off you're going to be when you're communicating this with your clients. So some scalability themes that we've talked about kind of over the course of the presentation. Can we group common tasks into company-wide projects in an assembly line fashion? Do we have consistency? So do we have templated messages for emails to clients? Do we have checklists that folks can follow? Are there standard deliverables? And is there any way to automate some of this, to eliminate some of the labor-intensive repeated tasks? We'll say, Holistiplan was kind of born out of this theme of how do you do a tax return review at scale without it taking 30 to 45 minutes each time? Is there an opportunity for computers to do what they're supposed to do, which is to do regular repeatable tasks at a much faster clip than humans can do them? A couple of bonus items here as you're thinking about pre-meeting tax planning. So, with a solid yearly process, your meetings can focus on taxes within the context of an overall plan. So you're not just pulling it out one meeting out of nowhere. And then at scale, are you using eMoney or MoneyGuide Pro or any planning software? It doesn't need to be these two, but if you're doing Roth conversions, are you able to show your clients the impact of those Roth conversions over that longer term time frame? So I think with that, we've reached the end. So I want to thank everybody again for your attention. Here, you can visit us at www.holistiplan.com or email us info@holistiplan.com if you want to find out more about the sorts of things that we do, or if you want that tax return review checklist that I referenced earlier in that presentation. So with that, Heidi, it looks like there was one question that you passed along to me where somebody asked, should we proceed soon with doing backdoor Roth contributions for 2022 before the final tax bill comes out? Brian, your guess is as good as mine. So, one of the things I'm not allowed to do, we don't give tax advice at Holistiplan. We know about as much as you do in terms of what's coming down the road. The way that I would approach this, or that you might think about constructing a framework for this, is because nothing changed, technically are the rules still the same in 2022 as they were for all of 2021? Right? Is that possible? Maybe. Is it likely or logistically feasible for the government to say, yeah, you did something in January and then in February we made it illegal? How are they going to logistically back out any of those activities? It's not to say that they can't do it, but those are the sorts of things that I think you would want to go into your decision tree and the comfort level that you might have if some of those decisions turn out to be wrong, right? So I don't know. That's the best answer I can give. I don't know, but just whatever your answer is, are you comfortable with the process that got you to that decision point so that you can justify it? Andrew asks, do you have a tax planning checklist for the full year and decision trees for common tax planning scenarios or Roth conversion analyses? So we actually, I don't know that we have a checklist for the full year outside of some of the things that we talked about inside this presentation. At Holistiplan, we don't have decision trees, but there is at least one company, FP Pathfinder, that has built their whole business on checklists and some of these decision trees. So that might be something that's worth exploring. So Jay asks, given the breadth of tax strategies, how do you suggest tagging clients in CRM that provides the best decision tree? It kind of depends on the sorts of things that you're comfortable with. So, and you might be able to have multiple tagging. So if you've got a really good CRM, you can give multiple tags to people. So that could be, one classification could be accumulator, retiree, high income, low income, right? Or it could be, these are people who have done Roth contributions in the past. These are people who have done charitable contributions in the past. These are people who are of QCD eligible age. The structuring of that is kind of endless. So I think you just want to start creating those categories in a way that is at least understandable to you, that gives you the best opportunity to pull that list of folks who would instantly be eligible. So just one example, Salesforce, great tool, right? If you recall, in 2020, is it 2020? Pretty sure it was 2020. 2020, when the IRS said, we are going to suspend required minimum distributions for this year, but they did it partway through the year. Did you have an opportunity within Salesforce, could you easily have gone back in and say, here are all the people who did an IRA distribution, because you've been categorizing things by workflow, but who are also over the age where they needed to take a required minimum distribution. So the ability to go back and easily identify folks for whom you might want to undo that distribution, right? The opportunities here are endless, but it's got to be something that's going to fit well with your decision process. So Lauren asked, with Roth conversions, does the software take into account the IRAs that need to be included in the calculation for taxes? Lauren, I'm not quite sure I understand all of your question. Is if the question is, does it take into account basis for IRAs? So Holistiplan as a product, we don't actually do that calculation. We have a field that says, here's how much the taxable Roth conversion is, but at present, we don't have something that says, here's my Roth amount, here's my conversion, here's my conversion amount, here's my IRA balance, here's my basis. So it'll auto-calculate the taxability of that. We just have the field for entering the amount of the taxable Roth conversion amount itself. Stephen asks, does Holistiplan have the ability to estimate the long-term value of Roth conversions for a client? So great question. So the end of this is under a set of assumptions regarding future returns and future marginal tax rates. So no, so we don't have that long-term ability. We don't have the opportunity for people to put in growth rates for that Roth conversion. That's going to be something that's going to be better served in that longer-term projection software like MoneyGuide Pro or eMoney, or even just a straight-up Roth conversion calculator. You know, some of the things that folks tend to think about, and this is something that can be built into your firm's decision tree, is how am I evaluating whether a Roth conversion makes sense for somebody? So does it always make sense? Do I think this person is in a lower tax bracket now, will be in a higher tax bracket later? Do I care if it looks like their tax bracket's not going to change over a period of time? I think one of the questions, Stephen, that gets challenging is that long-term conversation about future returns and future marginal tax rates, it's kind of a crapshoot, right? Obviously, we know returns are crapshoot. We don't know what that's going to be. Now, you might put in different assumptions for returns and figure out, okay, if returns are at least this much, then maybe the Roth conversion makes sense. And if they're not, they're not. But future marginal tax rates are hard, right? If we had started talking about tax planning 10 years ago, so 2022, we had no idea that tax rates were going to look like they are now. Right? So any sort of decision that you might have made back then thinking tax rates can never going to go lower than they are right now, well, it turned out to be wrong, right? Because they did go lower. So we have this conversation now, well, tax rates aren't going to go any lower than they are right now. That might be true, but 20 years from now is going to be a completely different tax regime, just like 20 years prior to now is a completely different tax regime. So that's a little challenging. The best that you can do, I think, is to say, here's the rules that I've got right now. Here's what's potentially going to change if nothing else happens when this current set of rules sunsets out at the end of 2025. That might be an interesting exercise to look through. But as the question relates to what Holistiplan can do, because we're not projecting that far into the future and we don't have the opportunity or the ability for folks to enter rates of return, that's not something that we would be able to support right now. But great questions.
Okay, that is all the questions we have right now. Any final thoughts for us, Ben?
The only final thought would be, to the extent that folks want to engage in this service, if they haven't already, one of the things that I think is becoming more and more well known is that alpha is generated on the investment side of things, if it ever truly existed, is decreasing considerably. But when you're talking about tax planning, this is something that has the ability to impact your clients every single year. And you can demonstrate a lot more alpha now, I think, by keeping clients' lifetime tax liabilities low than you could through any sort of long-term investment philosophy or approach. So, you know, we think, obviously we're biased, but we think there's a huge benefit to doing ongoing tax planning for your clients, and software is going to give you the best opportunity to do that at scale.
Sure. Okay, on behalf of NAPFA, I'd like to thank you so much for an informative program. This is one of our best NAPFA Partner Solutions webinars. Thanks for attending, everybody, and please do complete the survey that will pop up when I close the webinar, and that will give you a chance to request contact from Ben or one of the representatives of Holistiplan and ask additional questions there. Thanks again, Ben, and have a great afternoon, everybody. Bye now.